Ms. Breslow said she was the liberal on the panel, but she sounds a little like the Cato Institute this morning.
There's that financial versus social distinction.
Yeah. Ms. Nazareth.
Thank you. This is a topic that is obviously very timely and apt given the ambitious reforms to financial regulation that we're looking at. And I appreciate the opportunity to be here. I sort of wonder when I'm invited to speak with Paul Atkins whether I'm here for comic relief, because obviously we had a reputation of being on sort of opposite sides of the political spectrum. Never. But so I will, I think, offer some points that may be somewhat different from the panel, but ultimately, as you can see from this chart that I offer, I do have some concerns about the current structure of financial regulation. So I thought I'd discuss at a very high level 3 points. One is when regulation truly is necessary and appropriate, and I think I certainly come out on the side of believing that regulation has some appropriate role in our markets. And then basically what are the models of financial regulation that we could have been considering in this financial regulatory reform debate, and then ultimately, what are these proposals and what is being considered by Congress. I think it's fair to say, obviously, given my own experience as a securities regulator, that I truly believe there are instances where market forces alone aren't sufficient to achieve efficient and optimal outcomes, and that we really can have well-conceived and balanced regulation sometimes that can serve an important role in enhancing market competition, correcting market inefficiencies, and mitigating collective action issues. And without getting into too much detail, there are sort of classic examples of when regulation makes sense. One classic example is when you have a monopolistic player that dominates a market and extracts excessive, monopolistic rents from others. And so to enhance competition in such a dominant market, you need regulation. Antitrust regulation is a classic example of that, but even the SEC has had examples where they have gone after monopolistic practices, such as in the options market, and effected change that resulted in very dramatic improvements in the market, narrowing spreads, increasing competition, improving the markets as a whole. Another area where regulation plays a very important role is correcting market inefficiencies that result from principal-agent conflicts. I mean, you always hear about these externalities. Principal-agent conflicts is a very big area where the SEC has played a significant role. Obviously, the conflict between a broker and the broker's customer, or the conflict between an investment advisor and its customer. There are many, many regulations that address those concerns. Another classic example is collective action issues. When you think about all of the, among other things, the infrastructure of the markets, and how if you didn't have sort of common rules on how transactions are cleared, how transactions are reported, you obviously wouldn't have the benefits and the efficiencies of our system that we have today. And then, finally, an overarching theme in securities regulation is transparency. And the SEC is certainly, known as a transparency regulator. The term that sunlight is the best disinfectant, I think, is one that most people would agree with. And all manner of transparency, including disclosure, trade reporting, all those types of things, are sort of central to what market regulators do. So I think I've made the point, hopefully not too exhaustively, that I believe in the power and justification for good regulation. But even well-conceived regulation isn't the end of the story. And what we really need is also a well-designed framework in which regulations can be efficiently and cost-effectively applied with the least burden. And I think if you look at this chart that is being displayed here, you can see our current regulatory framework is really quite Byzantine. And it harkens back to the Great Depression, when financial institutions were separated along very distinct lines. You had securities firms, brokerage firms, and insurance companies, and they had very different regulations, and their regulators were also very clearly demarcated. But what we've seen since the 1930s is a great shift in how financial regulatory firms how financial firms operate, and neither the regulations nor how the regulators themselves are organized has been addressed or updated in order to accommodate these changes. Actually, even before the financial crisis, there were some regulators and former central bankers and the like who participated in the group of 30 who decided under the direction of Paul Volcker to sort of study the models of financial regulation and think in advance of all of this debate what would be an optimal model for financial regulation if we had the opportunity to start again. And the group, and I wrote the report for the group and worked on that study. What we came up with was basically there are 4 models of financial regulation, and the one that seemed the most optimal for the U.S. to consider, and you see the discussion of this in the Treasury, the Paulson Treasury's initial blueprint, was what's called a Twin Peaks approach, which would mean that you could have, regardless of whether you're insurance or you're engaged in insurance or securities or banking business, you could have one federal regulator that focused on the safety and soundness of the financial institutions, and then you could have a separate regulator that focused on business conduct activities. So really focused on those sort of investor protection, sales practice issues and the like across products, not in a sort of fragmented system where everybody's under different rules depending on whether the product is labeled a security or a banking product or an insurance product. Well, I would say that one of the unfortunate disappointments of the current debate is, I guess, in the context of this whole political arena in which we operate, the opportunity to reconsider the structure of financial regulation has been lost, or certainly there's been a decision not to tackle that issue. And so, in fact, what is most disappointing is that, as a number of people have said, a crisis is a terrible thing to waste. Well, we really are wasting this opportunity to reconsider how we could streamline this structure that you see up above here. What we could have done was, at the very least, consolidate a number of the regulatory agencies, if not most, for purposes of safety and soundness. And we've done, in fact, it seems the opposite. We've created more regulators and regulatory agencies. So we now are going to have, for instance, a consumer CFPA, Consumer Financial Products Agency, which will consider some, but not all, of the issues around consumer, sales practice issues, consumer issues with respect to products, but with some carve-outs, as would seem appropriate for those agencies that are already sort of well in the business of doing that, such as the SEC and the CFTC, but not the banks. The view is that the banking regulators sort of dropped the ball on consumer regulation, or at least were not as sharply focused on those issues as the securities regulators, and therefore, the supervision of the banks with respect to consumer issues was going to be moved to this entity. But wait, the community banks have come in and said, but not us. This would be too burdensome for us, so we'll carve out the consumer agency. So again, if we could redo this chart, it would become more complex, not less complex. And I think, again, that ultimately that affects the efficiency, the effectiveness, of regulation, because we're going to have more regulators, more overlaps, potentially also at the same time more gaps, and I think that again is a serious problem.